Welcome to the MHP Exchange podcast, where industry veterans Frank Rizzo and Eric Busadil generously share their wealth of knowledge in their new podcast dedicated to the manufactured housing space. They tackle tough questions to provide valuable insights for those considering investments in mobile home parks. If you're seeking answers in the manufactured housing space, this podcast is your go-to resource.
And welcome back to another episode of the MHP Exchange podcast. Frank Rizzo here. Eric, still wearing those brown pants.
All right, Frank.
So we're back, and each time we're here, we're always looking to add value to our listeners. If you're out there looking to grow your real estate business, whether it's in the MHP space or not, trying to give you tips and tricks, things that we've learned and things that our guests can share to help you scale your business. And today we have a guest, Daniel Weisfield from 3 Pillar Communities. And if there's anybody who could talk about scaling a business, I think Daniel, who's become one of the top 30 largest operators in the country, will probably be able to share a little bit of wisdom on that. And we're very glad to have him on today's episode. How are you doing today, Daniel?
Good. Thank you for having me. I always like when people set the bar low and say, don't expect much out of this guy. So, let's chat. Thank you for having me on. I really appreciate it.
So we appreciate you taking time out of your day to come on. And before we really do a deep dive, why don't you just, for those of us or those of you, for the people who aren't aware of who you are or who 3 Pillars are, why don't you give everybody like a brief history of your company and how you got into the position you are today?
Sure. So I cannot take credit for discovering mobile home parks as a type of real estate. My grandfather gets the credit. He immigrated to the U.S. from Israel with my mom when she was a little girl. They were poor chicken farmers in Israel. They came to the U.S. with nothing. He worked as a car mechanic, saved money from fixing cars, and eventually bought a mobile home park around 40 years ago. So I grew up around that business with my grandpa. We'd go fix bumpers in his body shop, and then we'd go over to the mobile home park, and we'd be out there, painting fences, cutting grass, digging ditches, fixing pipes, that kind of stuff, because he was a very hands-on operator. So I grew up around that business. I saw that mobile home parks are a really important source of affordable housing, and also an investment that tends to do well over time. And so grew up, got an education, did some other things in the corporate world, and then I started a mobile home park investment business about 8 years ago with my co-founder, who's my wife's brother, and just bought a small park and figured it out, and bought a second park and figured it out and started growing. And here we are now with 80 parks, roughly 8,000 lots, and around 130 employees.
So that's first of all, that's a kudos to you for building out a big, enterprise. And Daniel's a little
Not too shabby.
Not too bad. He's a little modest because it's very rare that you have a Yale graduate that also decides to get into the mobile home park industry. Was that like a course that you took at Yale, or was it just?
Yeah, in the economics department, Yale had a master's seminar in mobile home park investing. No, it's funny. People always bust my chops about going to Yale, and it's true. I went there. It was great. I'm grateful for that education. It opened my eyes a ton. I came from California, kind of a narrower viewpoint of what was possible, right? And then I showed up at Yale, and it's like people were becoming senators and journalists, and there are presidents of the United States who went there, and all sorts of stuff. And you kind of just opens your eyes to all the possibilities that are out there. And like I said, I still didn't occur to me to do mobile home parks for a long time. My first job out of college, I worked as a U.S. diplomat, actually, at the State Department. And it was only when I got a little older that I realized I really am an entrepreneur. I really want to create something of value. I'd like to leave some kind of an imprint on the world. I like the creativity of business, and I really like being able to positively impact people's lives by providing safe, good neighborhoods and safe housing. So that's kind of only later in life did it click for me that mobile home parks is an amazing opportunity.
The interesting thing about it is that you kind of, because there are a lot of people who stepped into this space recently with a different pedigree than previous generations, like your grandfather coming in as an immigrant, realizing that this is a great opportunity for growth. But you've learned this business from the bottom up, right? You were there working on homes, mowing grass, and now you've kind of taken a secondary role as now the owner operator, right?
Yeah, that's exactly right. Yeah. So, I think growing up in a family that did mobile home parks gave me the confidence to jump into the asset class. I honestly don't think it gave me a lot of concrete knowledge on how to operate. I think a new person coming in can come in with fresh eyes, right? And none of this is rocket science, right? It's be fair, treat people right, be smart, right? And you can figure all this stuff out.
But when you first started buying, you were in California.
Yes.
Correct. So you essentially were buying in, and we're in New York now, right? But you were essentially buying in one of the most regulated markets in the country.
That's right.
So you're in New York, you're there. Like, what was your playbook for growing a portfolio and thriving in a highly regulated market?
So I think if you can operate in a highly regulated market, then you can operate anywhere. In California, we had to be so on point in terms of compliance and making sure every I was dotted and every T was crossed in our leases. And there's so many procedures you have to follow, which are mandated by the state. It makes you a smarter, better, more organized operator. And so that's where we initially built our business, was on the West Coast, because that's where we were based. And it was only as we grew over time that we started looking at the whole US as a possible investable opportunity. And now at this point, we're investing, we look at deals in all 48 states. And we own now in 15 states, including in the Southeast and some markets where I think you guys are active, right?
Correct. I think we're complementary in some of the places that we're in, and we'll get into that. But I always find it interesting because I know for us, right, we growing up in a highly regulatory environment and dealing with tenants in New York, I think when we looked at this business, the first thing we were looking for is let's go to states where there was some clarity, where we knew if we operated correctly that there was some clarity and at least fairness in the rules.
Yeah, I got a lot to say on that point. Our mission is to provide safe, reliable housing to residents and safe, reliable returns to our investors. And we think that in order to succeed, we need to do both those things: take care of the residents and take care of the investors. And I'm really proud of the way we operate and the way we treat our residents. I've bought dilapidated parks and we have cleaned them up and gotten rid of drug dealers and criminal elements and created safe neighborhoods that people are proud to call home and where kids can walk safely to school. And we've put in playgrounds and dog parks and just upgraded the housing and made it safer and cleaner. And I feel so proud of what we do. And I feel like in markets like North Carolina and South Carolina, we are respected. We are seen as providing a valuable service as a housing provider. And kind of the government says, thank you for doing that. And in other states where we operate, it feels like we are criminalized for being a landlord. It's like, we can't do anything right. We're evil for being a landlord. And no matter how much good stuff we do for our residents, politicians pass laws that kick us in the teeth. So yeah, I've got a lot to say about that, but I will try to not go on a long rant.
I can understand that.
And now, Daniel, so you basically, grandfather started you in the business, you learned about the space in the business, went to school, and you basically started your own business from scratch, right? You didn't take over an existing large portfolio.
I can't claim that I started from scratch. That would be incorrect. My family owned a handful of parks when I got into the business, which they were operating really as mom and pop operators. My aunt was running the business and she had one employee who was helping her with the bookkeeping. And I came in and I took over that small handful of parks and started cleaning up the operations. And I was able to actually start drawing a management fee from those, which helped kind of keep the lights on at my house and put food on the table. And then I started my own business to buy parks with our own investors. So that's Three Pillar Communities. That's the business I started with my wife's brother in 2017. And Three Pillar Communities has gone and bought, roughly 70 parks.
So in 8 years, you've gone from a handful of communities to close to 10,000 units, right? That's
Around 8,000 units. Yeah, that's right.
Okay. And what was the? I mean, that's a short window to get that big that quick. For those who's listening, I mean, what was the determining, or like there had to be like a pivotal moment in your 10-year run or 8-year run that took you to that next level?
I can't think of a pivotal moment. Honestly, I think it's a marathon. It's the long, slow, continuous pursuit of excellence.
So
We did one deal and we did a second one, then we did a third, and then we did okay on that, so we did a fourth, and we started hiring people. The word got out in the investors, we got a fifth. The word got out to the brokers, they started bringing us more deals, we got a sixth, then a seventh. It's been really incremental. I would say if there was any turning point, it was probably when we realized we don't need to stick to our little backyard on the West Coast. We could look at the whole US as the universe that we could invest in. I think that really opened the aperture. But even then, operationally, it's just been putting one foot in front of the other and really, making mistakes every single day and trying to learn from them.
But that's a great point, because at some point you went from, hey, I'm scaling this localized business, and California is a big state, but you're all within that region, and you're saying, look, I can open up that door and get comfortable buying 1,000 miles away from or 2,000 miles away. Like what was the thought process, and how did you change maybe systems or processes that you had in place? Because obviously what works in your backyard doesn't necessarily work when it's across the country.
That's a great point. So I think we had built scalable systems within our own backyard before we went and looked at buying across the country. So, in the first 3-4 years of our business, while we were focused on the West Coast, that's when, initially, the very first deal, I was the community manager, right? I was interacting with tenants. I was signing leases. I was calling the contractors to come fix stuff, right? I was the community manager for the first 2 or 3 deals, right? And then once we got to several deals, then I was hiring community managers and I was their boss, right? So I was essentially what we now call the regional manager, right? Deeply involved in operations. And then it's probably when we got to 15 parks that we said, okay, I'm no longer going to be the boss of the community managers. We're going to hire our first operations director or regional manager to be that layer between us and the community managers, right? And so that was probably a bit of a turning point where we started getting some scale in operations. We started having levels of management. We're using, we got our back office systems down. We use Rent Manager to collect rents. We started building we started hiring bookkeepers and having effective ways to process invoices. So we got all that built out. And then we started using it. The first deals, you just do it haphazard on the fly. Then as we started growing, we built an acquisitions checklist. Here's all the things we needed to do and make sure we dot every I and cross every T on every deal, right? So we built out all that infrastructure. And once we could deploy that in California or Oregon, it didn't feel that different to go do it in Texas.
Got it. And I think, obviously we're talking about scale, and we love talking with operators who have scaled to levels like not everyone scaled to your level, but to see the different challenges or the pain points you have along the way, right? It's that first 100 lots, then it's the first 500, then it's 1,000, and there's different skill sets you need and different people you need at different points. And I guess one of the toughest challenges that we have as operators is we know that we're filling too many roles in the organization org chart, right? Like, so we're at this level, but we're also down here. And it's like, what boxes do we tick off to buy back some of that time to focus on the bigger picture? You still find that as an issue?
100%. I'm right there, brother. I wear my, CEO hat, but I am the investor relations person. We don't have anyone handling investor relations. So when investors reach out, it's either I'm talking to them, or if I'm too busy, sometimes I don't respond to the email and no one talks to them, right? That's a failure on our part because we don't have someone sitting in that role. We're not scaled that big yet. And then I'm spending a bunch of time on operations stuff. We just had unfortunately, we just had someone get bit by a pit bull in one of our communities last week, and I'm on the phone with the insurance guy, and I'm dealing with the lease and the eviction, and trying to make sure that the person who got bit is okay, right? When stuff pops up, I'm putting out fires, and at the same time, I'm trying to think strategically about, how do we get to the next 10,000 lots, and who's my next capital partner going to be, and what markets should we be in, and how do I build talent in my company, and how do I build a great culture in our company, and how do I make sure the residents love living in our communities and tell their friends and they want to come. So I'm also strategic, tactical, stretched too thin. I'm definitely not past that.
And Daniel, all interesting stuff, Daniel. What type of asset do you go after? Are you doing value add? Are you purchasing stabilized properties? You get to where you are in such a quick period of time. I'm just curious, like, are you gobbling up anything you get your hands on?
So I have maybe a unique, I don't know if it's unique, but I've got a certain strategy on that. We tend to be agnostic about what kind of properties we want to buy. I don't have one set idea. I only buy value add. I only buy stabilized. We try and look at the risk and return on each deal and see if it makes sense. And so I've bought stabilized properties that were beautiful and didn't need much work. And I've bought empty parks. I bought a park in Union Gap, Washington that was, 80 lots with 10 homes on it. And we went in, we filled up 70 lots, right? It's almost like developing a new park. So I've done all of the above. I do think the way we've been able to get more scale faster is doing less of the small, heavy value add deals, which suck up a lot of your effort as an operator, and doing more of the bigger and more stabilized deals. And the problem is the bigger, more stabilized deals are more expensive and the returns are lower, right? And so that's where it becomes a discussion with your investors about what is a reasonable expectation for a return on investment. And if I think, if we're taking care of our residents and our residents are happy and they're staying long-term and these parks are very stable and we don't have a lot of resident turnover and we believe that there's a demand for affordable housing, then I don't think it's reasonable for investors to want a, high teens return on investment. That ain't going to happen. It might be, 8, 9, 10, 11% annual return on investment. That feels appropriate to me for a less risky real estate investment. And having that education with our investors has allowed us to buy some more of those more stable parks.
So that's a great point, because we tend to focus on like these deep value add projects. To your point, it becomes even training the staff to do that work. It's not like you're getting your typical property manager, because the property managers really got to fill 4 roles, right? They're the brand ambassador, they're a project manager, they're handling sales, they're handling collections, and it's training the property manager to think like we do, right? And manage your costs and manage the contractors and the work that's happening there. And that's a lot. To your point, it's a lot of work and it's a lot of personal relationships that you're training them. And Eric really handles that portion, and he does a phenomenal job of just that personal relationship with the people down on the ground. But it's a lot of bandwidth, right? So you need to have that return. It's a lot of bandwidth to execute on those opportunities.
Yeah, and just to build on that, it's ironic. If I look at the projects that I'm proudest of that we've done, it's the parks that we bought that were broken and residents were driving on potholed roads and it was muddy and the former owner didn't care at all. And we came in and we did heavy value add and we cleaned it up. And I feel good because I see the moms walking down the street pushing the stroller with the kids and they're proud of where they live. That's what makes me proudest in my heart. But where have we made the most dollars? It was buying a stabilized, perfect property that needed nothing, and we held it for 2 or 3 years, and someone came along and paid us a whole lot more money for it.
Wow, so interesting look at that, and looking at it from that lens, it's allowed you to go across the board and operate that way. Now, when you move into a new market, is there, you can, I've obviously checked your portfolio online, and you could, it's not say scattered, right? But is there a way that you go into a new market? Is there a way that you look to expand when you hit a new market? Like how do you approach that?
So I would say if I'm buying a park that's 150 lots or more, then I would do that as a standalone investment, basically anywhere in the continental United States. So if I find a great 150 lot deal in Maine or New Hampshire or Michigan, fine, we'll do it. We have regional managers now who cover every quadrant of the country, and it's scalable. It's plug and play. We'll hire a local community manager. They will report to one of our existing regional managers. We'll build the local vendor relationships. We'll figure it out. I'd say if it's a little, a smaller park, in my book, the small end would be like 30 to 60 lots or anything less than 60 lots, let's say. I can't justify that as a standalone in a new market. So we looked at a deal in Ogden, Utah, roughly 60 lots. Great market outside of Salt Lake City. We'd love to be in Utah. The park itself looked great, but when we analyzed our management costs and our cost to fly out there on a quarterly basis and everything, it didn't work. So we had to say no to the deal.
And do you have filters for, hey, this is a county or city we'll look in, or this is a county and city we won't?
I don't. I know a lot of investors start with those kinds of filters. My personal opinion is that there aren't a lot of mobile home parks in America, period. The stat I've heard is there's 50,000 parks. And, a bunch of those are little 5 and 10 lot parks that aren't really, something we're looking for as an investor. They're an important form of housing, but they're not what we're looking for. So there's maybe 25,000 parks we'd even consider buying. And of those, very few of them are trading hands at any given time, right? There's maybe 1,000 parks a whole year in the whole country that change hands that would be interesting for us. So if I apply a filter right off the bat of which place I want to look in, I'm going to miss a lot. So I'd rather say I'll look at any single mobile home park, and as soon as I see it, we do a very quick screen of market, median home price, crime, income, and then look at the property itself, right, and decide whether it makes sense or not. So
you're looking more on the deal level, right, rather than so if it's a
correct
stable or declining market, or it doesn't, or does it change? So what we've noticed is there's, we could put things in two buckets, right? Whether it's if it's physically occupied, some of that county data doesn't matter, right? It could be in a stable, even a slightly declining market, and we can execute a business plan. But if it's a infill project, we need that's where the county and the city matter, because if you're not seeing growth or you're not getting a certain median sale price of the traditional built homes, then it's going to be very challenging infilling with new homes. And I'm sure you probably
100%.
New
100%.
So,
And
that's how we kind of break up the opportunity into almost two different baskets, and then try to run our analysis through that lens.
Yeah, I think that's a great way to articulate it. And I don't know if you have any stories about this, but we learned that lesson the hard way, right? Buying parks with vacancy, thinking we'd fill it up, and the market is the market is the market. It's the most important thing in real estate. And sometimes I think investors fall in love with the mobile home park story, and they'll go out and buy these empty mobile home parks in the middle of nowhere because, hey, it's a mobile home park, you can't go wrong, and it's an infill opportunity. And if it's a declining market and there's no one there to move in, that infill is a hard slog. And we've been there. We've tried to fight it out. Have you ever had that kind of an experience?
Absolutely. I mean, I think we've noticed that there's certain markets where we brought in, you bring in homes and they sit or they don't sell as quickly as you think. It's not that you're not taking applications. It's just they're not getting qualified through Triad at 21st. And so now you're faced with the decision, do you want to put it on a rental line, right? Which is not ideal, because the whole idea is we want residents to own their homes in the community, not that we have tenants cycling in and out. And so that becomes part of the challenge. And I think that's just, to your point, not every market is a new home market. And I think most people in the space make that mistake at some point, and you realize, all right, let me pull back. And so we've kind of filtered out, like, where have we done well in infill, right? Here's where we've done well, and here's what we need to see in terms of growth in that area and price points in that area where traditional rental prices are, going to be 10% or more than the cost of the new home. And that's where we've seen that we've had a lot of success.
Yeah. What are the markets where you've had the most success on filling up parks, filling vacant lots?
So we're having a lot of success in Onslow County, which is in North Carolina, in Jacksonville.
I'm sorry, which county?
Onslow County,
Okay.
right in Jacksonville, we're having a lot of success, new homes there. We're in Laurinburg, North Carolina, which is doing better than anticipated in terms of the home sales there. So we were very happy with that. We were in South and Middle Georgia, in like the Byron market and the Valdosta market. Those two markets, there's a lot of demand, and we saw some strong price points there. So those are areas where we felt that you can do, because of the vibrancy of that market, you can handle some infill. But we've seen other markets where it's just not going to move as fast.
Absolutely. And that if there's any new investors listening, this is where you got to know there's a difference between wearing your the broker glasses and wearing your investor glasses, right? A broker is always going to see vacancy. They're going to say, hey, this is a great upside opportunity. That's their job, right? They're salesmen. As an investor, you got to say, is this an opportunity or is this a risk?
And is that what you do? Are you focused on bringing in new homes? I've talked to some operators who bring in resale homes. Where do you?
We believe pretty strongly in bringing in new homes and selling them so that we create residents who are homeowners. We have done used homes before, but used homes are tough and it's hard to scale that model. And I think the best way to upgrade the real estate is to bring in new homes. It's the best way to improve the appearance of the park and the value of the park. So I try to buy parks in markets that can support new home sales. That's a good indicator, right? If you're buying a park in a market where you can't support a new home sale, it has to be a used home, it might not be the strongest market to begin with. Correct. So we try that. We don't always succeed, but we try to buy parks in markets that can support new home sales. We like to bring in new homes to provide real value to the customer, right? We're having a lot of luck with 3 bedrooms and even 4 bedrooms. I hadn't done 4 bedrooms before. That was a new idea for me. And we're getting a lot of working class families who really value the space. They value the bedroom count more than they value having a fancy countertop, right? Or a stacked stone fireplace or whatever. So bringing in as much square footage as we can with the kind of more economical finishes and selling that new home to the end customer is really where we want to be.
So why don't you walk us through like a recent, if you don't mind, like what's your most recent acquisition? What was it that drew you to it? What were you looking at?
Okay, well, I'm closing on a deal today.
Okay.
So maybe I'll do today's deal.
Okay.
We are closing on a roughly 150 space mobile home park just outside Charlotte, North Carolina.
Okay.
It has about 30 vacant lots. And when you look at a deal with vacancies, you always got to say, is this a market problem because there's no demand, or is this an operator problem, right, from the prior owner? And it's clear in this case, it was an operator problem. Tons of demand in the Charlotte market. It's a robust, vibrant market, tons of job creation, population growth. And the park was just owned by a family for 50 years. They built it, right? Grandpa built it back in the day, and they haven't cared to put homes in it. Why would they? They're cash flowing and they're fine. So when I think through that deal, I love the Charlotte market because I like the population growth, the economic growth. I love the size on this deal. It's 150 lots. So I think, it's the kind of park that is more valuable based on the scale. You get some operating efficiencies. And I love the opportunity to bring in new homes, create more homeowners, and increase the value of the park.
So what's the plan going into this? Is it rents at market? Are they below market? Do you have CapEx to do there?
Rents are below market, which is what we often see with mom and pop owners who've owned it forever. And we can have a whole discussion about that. But my big takeaway point on that is if we want to have sustainable mobile home parks that can continue to provide affordable housing for the future, we need to charge fair market rents. Otherwise, these parks will eventually be redeveloped into other uses, right? The only way to keep these parks alive long-term and to reinvest in them and improve, invest CapEx and improve the infrastructure is to charge fair market rents. So we're going to raise the rents. I don't feel bad about that. I don't apologize for that. We're going to charge a fair market rent that still provides strong value to our residents and is cheaper, much cheaper than what they'd be paying to rent an apartment. And they get to be a homeowner. So we're going to raise the rents. This particular park does not need much capital investment. The prior owners just did the roads. It has direct build utilities. But we're going to provide curb appeal improvements and other quality of life improvements for residents. We're going to put up new signage. We're going to put up a playground for the kids, and we're going to install a soccer field with soccer goals, which people are excited about here. And then we're going to start bringing in new homes, right? And I think the quality of this community will be transformed. And right now it looks a little ramshackle, to be honest. It's been neglected, and you got weeds popping up and older homes, and we're going to make it a place that residents really are, like I said, are proud of and are proud to bring their guests to.
All set.
And I think you hit the nail on the head, because even though, rents have to eventually get to market, but if the resident there sees some value back first, then it makes it easier to accept. So whether it's playground, whether it's road improvements, we've even gone into some places where we know we want to bring in new homes, and there's homes that are maybe wouldn't meet community standards. Like, we like to set a standard. Hey, we'll go in, we'll fix your deck, we'll skirt your home, we'll power wash, we'll clean it. But by the way, instead of you paying a couple of $1,000s to do that, we're going to do the work, right? And we've taken on that in our underwriting. But hey, we've got to guide your lot rent up. But the resident has got something in return. It's not so much that we just asked for this. We said, we're raising standards. Your home doesn't meet standards. We're going to help you get there. But we also need you to help us get closer to market rent along the way. So there's a symbiotic relationship there, and we can continue to maintain the park that way. And I think when you take that approach, like you take, you get a lot less pushback. Not everyone will always be happy, but less pushback, and you're then able to continue to run a good, stable, beautiful community that people are proud to call home.
Exactly. Treat people the way you want to be treated. It's not complicated.
Now, I've heard you on other podcasts, and I know at one point you were doing correct me if I'm wrong, you were doing a development deal, like ground up, right?
Yes, that is correct.
And I want to talk about that because, you hit on a couple of things that, listen, this is the only asset class in real estate where they're not making any more of it, right? Like, the old adage in real estate was, hey, you might as well get into real estate because they're not making any more of it. Yet they're making more multifamily, they're making more industrial, they're making more storage, and they could do that anywhere. However, there's a finite amount of mobile home parks, and every year we close more than we open. But you were going through the battle, dealing with the counties, right? Dealing to try to get a mobile home park approved. Maybe you want to talk a little bit about that story and how that process played out?
Sure. So we bought 90 acres of farmland from the Dykstra family in Bozeman, Montana. I went out there. I met, Grandpa Dykstra. He was riding his tractor on the property. We shook hands. We made the deal. And Bozeman was a very hot market during COVID. This was in 2021. The median single family home price there spiked from $400,000 to $700,000 over the course of 2 years. And all the locals are getting priced out of housing. And it was national news. People were putting 20 bids on a house. They couldn't get anything. And I said, all right, this is clearly a market that needs affordable housing. We're going to buy this land and we're going to develop a new Class A manufactured housing community. And we got approvals from the county. That wasn't the hard part. They actually wanted us as a partner to provide affordable housing. And we started building. And at this point, the community is open. We have residents living there. We have a sales center that's selling homes. We've got a playground for the kids. I'm really proud of what we built. That being said, our home sales are much slower than we had projected. We put in expensive homes, all double wides, pit set, which is a special set, so it looks more like a normal residential home instead of elevated up on blocks. We did custom site-built garages at every home. We're selling in the $200,000 to $250,000 range, which I thought made perfect sense when the median single-family home price was $700,000. But these days, if you want a loan on a manufactured home, the interest rate is 12% on chattel. And so we've got customers who want to buy But when the lender looks at their debt to income ratio, they're having a really hard time getting financed. And so I'd say our sales are much slower than we projected. And financially, this project has not been what we had hoped it would.
But it's good to hear that the county.
I'm sorry, Frank. Was that a subdivision or that was just a straight land lease?
Land lease.
So one of the challenges that we have here is that I think the customer needs more financing options in the manufactured housing space, right? So I mean, it's good to hear that the county approved this, because most counties just will not approve a new mobile home park. That they need, that they understand that there's a need for affordable housing, but there has to be a way to create better financing options for the end user, because when they buy a product, and it sounds like you're bringing in double wide, beautiful new homes, and chattel financing between 9 and 12%. I mean, that's a tough pill for the end user to swallow, because it's still supposed to be affordable, and there's no middle ground, right?
Right. Absolutely. I think the right way to capitalize this project would be to have enough money in the bank that you can issue your own home loans to the home buyers, and you can charge a more reasonable rate, like 7%, 8%, right? Help them get into that house. But we weren't capitalized to do it that way. But I think that's the right way to do it.
And the interesting thing is that, and look, we use 21st, right?
Mm-hmm.
But at the end of the day, I'm sure you use 21st mortgage.
Sure.
At the end of the day, even though it's a quote unquote subprime loan or chattel loan, they have a prime guarantor behind it, because in 6 months, if they have to take the property back, I'm sure you have to deal with the same thing we have to do. And, they want you to be responsible for it. Yet, that's where I think the industry could definitely use some changing going forward, that I think would only benefit the resident down on the ground. I think that would be a huge win.
I agree.
And it would help create even better communities, quite frankly.
100%.
So what's next for 3Pillar? Like, where do you see 3Pillar in 10 years? Where are you looking to take your company, your growth? And what's the goal?
I'm really focused right now on resident relations and resident experience. And I would like to get to the point where we are surveying every new home buyer to understand their kind of satisfaction with the experience. Would they recommend us to a friend or family member to buy a home in our community? Have recurring surveys of our existing residents. How are we doing for you, right? How's the community appearance? Are we keeping it neat and clean like we want to? Are we providing high value to you? Is our manager responsive to your needs, right? And get to the point where we are so confident that we're knocking it out of the park for our residents that we, have total confidence that we've made good investments that will continue to provide stable income for decades to come. That's what I'm really focused on right now. And I think if we can get that part right, it's kind of a bellwether for everything else, right? If we're getting top resident relations scores, that means our staff is great. They're well trained. They're bought in on our team. We've got good operations and processes in place. And then I think growth will be easy. Growth will just come naturally.
You know what I love hearing about that is, and there's a lot, we've all seen, like, in the last few years, there's a lot of new entrants in the space, and everybody talks about the numbers and why you want to be here, and sticky resident base and the economics of it. But when you talk about culture first, right, and the people live in these communities, and sometimes they live in these substandard communities, not because they can't move their homes. They stay there because there's a sense of community, right? And it's the culture that was built in, and they knew the grandpa who built it, and he knew who was trouble or who was in trouble, right? And he could discern the difference. And people like living in a community. They like being part of something. And if you build that culture, then people will stay, right? And they'll pay, right? But they'll stay. And if you don't, and we've seen some people come into space and they just ripping rents, people will leave. They will find the $10,000 to move their home because they want to live somewhere where they feel valued. And I love to hear that that's where you're looking to take the company and what you do. So that's a testament to you and your company. Good job.
Thank you. I'd like to see it become an industry norm, right? We're not there yet with everything built out, but we're working on building resident surveys and all these other engagement tools. And I'm hoping once we build it out, more operators will start adopting it. I think it's a good way to help shift the perception of our industry, because as you know, we're so often painted as something that we're not, right? We're painted as being often not positive, and in reality, as you know, we are working really hard to provide safe, positive environments for our residents.
Yeah, and it's like we look at community engagement as a way that our managers are doing well. We'll do lot of the month in each one of our communities and have the other managers do. And you could tell the community managers that have the most submissions, like percentage wise, right, that more of those residents are engaged, right? So the more engaged that people are participating, the more you're creating community, the more people feel valued. And I think that's an important part of being in the space that you can't miss.
Have you seen communities that didn't have a strong culture and you're able to turn it around and create more of that sense of pride among the residents?
I think that's typically where we look at, right? I think the first thing we try to do is change the culture and create a culture of accountability. And the first thing that we let the residents know that we're going to be accountable for holding certain standards, but we're going to expect you to hold those standards as well. So, our typical acquisition has probably been multi-generational. Maybe the owner's tired, maybe the family's not there, right, hands-on anymore. And so it's gotten to the point where things have gotten lax, standards and rules have gotten lax and not being followed. And that creates, in-house, turmoil. And we try to create some structure and stability in the communities that we buy.
Daniel, we focus on but our typical purchase is like a deep value add where we're cleaning up the community from start to finish,
Getting rid of drug dealers,
changing the culture. It's a 1.5 to 2 year play typically. Always that turning point that you can kind of see when it happens. You buy a more stabilized property, like you said, where homes are in good condition. There's not a lot of work to do. There's typically a better culture there already, right? Not much to change always, but for us, I mean, pretty much every one of our communities was a culture change.
And we, the same thing when you mentioned before, it's like chasing out the people that you had to chase out to get into people that you really want to be there long term. I mean, that's been part of those are your biggest stories and the things that you remember. Those are and we had a park that, the day we showed up, there was a drug dealer with tattoos on half of his face, and he'd drive a bike to 5 trap houses in the community. And then a year later, he's gone. Well, now we have a community filled with residents with children, and there's an ice cream truck driving down the street, and there's a whole gaggle of kids that are chasing them down. I mean, that's the heartwarming stuff that makes you feel like, hey, we're doing something. There's an economic benefit, but there's a real world impact benefit. And I think that's the beauty of being in this space. And that's what keeps it exciting, quite frankly. And that's why we love what we do, because you have the best of both worlds.
Yeah.
But this has been great. I want to thank you very much for appearing on the program. I think you've covered a lot. Eric, what was your biggest takeaway from today?
I just really like to see, the biggest takeaway from today is, he's across the country. His company's obviously, their operation has to be, on point to be able to buy a community all the way across the country and, get into it. But I think for us, we've started to expand our reach into other markets, and we're actively looking in other markets where we were solely focused on certain markets. But for me, that's very impressive to me.
Hugely impressive, and I take from that systems and processes in place, and then getting the right people in the in those roles. And then, secondarily, which Dana talked about, which was creating that culture, right? And starting from that first and then working your way down, whether it's on the ground or with your team, that's an important indicator of where you can take your real estate business. So two great takeaways. Thank you very much for appearing on the program today, Dan.
Thank you for having me.
And guys, if you're listening and you have a question about scaling your real estate business, click below, send your questions. We'd be happy to answer those questions. And if you want to see what we do on the ground and what it takes to turn around a community, check out our YouTube series, Trailer Park Turnaround. Until next time, happy investing.